Okay, hello everyone, and welcome to our webinar on cracking the top 3 challenges in climate risk reporting. In the next 45 minutes, we'll cover climate disclosure basics. We'll discuss the top 3 challenges in climate risk reporting and how to overcome these effectively. And we'll look ahead at future trends in climate disclosures as well. Before we start, some housekeeping. We have prepared some juicy content for you. But we want this to be an engaging format. So if you have a question, please feel free to type it into the chat box. At the end of the webinar, the speakers will answer as many questions as time allows. This webinar will be recorded. And if you have any further questions or need additional info on EarthScan, please reach out to us via sales@earthscan.com. A little bit of introduction. My name is Jakobus Lang. I'm a climate policy manager at Mitiga Solutions. Mitiga provides climate risk services via its platform EarthScan, which helps companies analyze, report, and act on their exposure to climate risks. And we are also a proud member of the IFRS Sustainability Alliance. I must add that the IFRS, being a standard setter, is impartial and does not endorse EarthScan or any other climate risk provider. So please be aware of that. With us today is Neil Stewart, Director of Corporate Outreach at the IFRS Foundation. Neil brings more than 25 years of experience in and around investor relations and corporate governance. Neil, it's great to have you on the webinar, and thank you so much for joining us today.
Thank you, Jakobus.
Looking at our agenda, we'll start with mastering the basics of climate disclosures using IFRS S2. Then we'll talk about the 3 challenges that we think are very critical. First, placing the IFRS in the fragmented climate reporting landscape. Then we'll share some criteria that help select the right climate risk provider. And finally, we'll discuss how to communicate climate risk effectively in financial reports. And ultimately, we'll have an outlook on climate disclosures and close with the Q&A session. To set the stage, so staying ahead of climate risk disclosure, I think, is more critical than ever. There's increasing pressure from investors and regulators. Over 50% of the world's GDP is covered by jurisdictions that have decided to use or are taking steps to introduce ISSB standards. So the ISSB's ambition to create a global baseline for climate disclosures is gaining a lot of traction. Neil, if you're thinking of a company that tries to disclose on IFRS 2 for the first time, what should they pay attention to?
Well, that's a great first question to start out with. So let's start thinking about some of the key aspects, the basics of S2. And one of the things that companies will recognize immediately is that S2, our climate standard, fully incorporates the TCFD recommendations. So requiring companies to disclose information about their climate-related risks and opportunities, building on the requirements in IFRS S1, and I'll tell you more about that in a moment, but it really uses that familiar, that incredibly useful structure that the TCFD did of governance, strategy, risk management, metrics, and targets. It includes cross-industry metrics and industry-specific information really necessary for investors to get a complete understanding of a company's performance and prospects in relation to climate risks. So climate-related risks, of course, again, familiar terms from the TCFD. Climate risks include both physical risks and transition risks, as well as then we talk also about climate-related opportunities. Now, I want to emphasize this. You can't do S2 without S1, right? So this is because IFRS S1 sets out the way that companies should approach reporting. And that includes key concepts like the need to connect information with financial performance, how to think about the value chain. S1 has guidance on assessing materiality when applying IFRS S2. And remember that you only need to report information that is material to investors. IFRS S1 also explains how to deal with things like changes in estimates and errors, provides reliefs from providing commercially sensitive information about opportunities, and it indicates when to disaggregate or aggregate information. So for any of those aspects of reporting about climate, an entity company really needs to use IFRS S1. So I wanted to make that really clear, because sometimes there's a misconception that a company could do S2, that's climate only, and maybe later they would start to do S1, which is everything but climate. And that's not the way to think about it. S1 covers the whole spectrum, including climate. And it's true, our relief, one of our key reliefs, gives companies the opportunity to start with climate only, year 1, and then to expand beyond that, year 2. But let's think about that as climate first, and then going beyond climate. But let's not think about it as just sort of S2 and S1, because again, you can't do S2 without S1. And then just a few more things to look out for when doing S2, really important aspects or components of it. One is that all companies are required to use climate-related scenario analysis to inform their disclosures about their resilience. But the S2 does not specify which scenarios a company should use. It does require a company to use relevant scenarios and provide information about the scenarios it has selected. The standard has guidance on scenario analysis to make sure that that requirement can be met. Sure that the requirement can be met proportionately. That is going from qualitative all the way to complex statistical modeling, but using reasonable and supportable information available without undue cost or effort, and also taking into consideration the skills, the capabilities, the resources available to the company. So a company can, if needed, can start with qualitative, and then move over time as they develop the resources, and as more new services and technology become available, they can move to more complex modeling. Similarly, S2 also has a Scope 3 measurement framework, and it also has proportionality approaches to accommodate those factors. So I think that's a good summing up of some of the things that you'll see right away when you dip into S2, and also when you dig deeper.
Mm-hmm. Absolutely. Thank you so much for the insights. And I think very interesting that you shared already some of the elements that are to be considered when trying to disclose this information. Also, for companies that might do it the first time, I hear you say that companies that have been reporting under the TCFD have sort of a little bit of an advantage, because they have sort of done first experiences with similar standards. Looking at some of the specifics to the standard is really the work that needs to be done when performing a physical risk assessment specifically. So we're zooming in a little bit on some of the requirements that are outlined in the S2, and what we at Mitiga see is the companies typically follow a 5-step approach to ultimately disclose something on their physical climate risk exposure. And I want to guide you through that just in a second, because it all starts with data on their assets and ultimately on their own operations, but also on the value chain, to have an input to then, in the second step, start performing risk assessments. And in that instance, they need to screen and really select the hazards that are material to their assets and business activities. Then the scenario analysis that you mentioned, Neil, comes into play, where really it's about mathematically modeling, and also looking at different time horizons that might just paint a different picture of the risk that the company is experiencing now and in the future. But then you also only know the exposure of these assets, and really the third step is to interpret these results and assess the vulnerability, evaluate the financial impact that these risks have. And the fourth step is then also to develop mitigation and adaptation measures. Before then, really the last step is to map results from climate risk analysis to reporting requirements. So with this generic process, which basically answers also to other standards that ask for a physical climate risk exposure, we see that there's still somehow a lack of standardization in terms of some of these elements, for example, the screening of hazards, or also the scenario analysis or the financial impact evaluation, are not yet set. So looking at IFRS S2 specifically, it says to perform scenario analysis, but it doesn't prescribe how to do it, for example, or screening hazards and also the methodology used to financial modeling isn't really prescribed. So the imminent question would be also, and I think I've even put it on the slide, how does the ISSB make sure that companies disclose data that is comparable with other industry peers?
It's a good question, and I really want to focus on that industry peers aspect of this, because one of the most important aspects of the ISSB standards is an industry-based approach. This is really important. This is really important to the ISSB standards, and there are 4 key reasons why it's important. 1, relevant sustainability-related issues vary by industry. 2, investors analyze companies and construct their portfolios by industry and sector. 3, an industry-based approach allows companies to really focus their reporting on the matters that most closely fit with their businesses. And 4, this approach reduces cost and minimizes noise by focusing on the most relevant information. So by narrowing the focus to the industry factors, it really makes it more cost-effective, efficient for companies to gather the information to report it, but it also surfaces the most decision useful information for investors. As a result, IFRS S2 requires companies to make industry-specific disclosures relevant to their business models and activities. And to do that, they're required to refer to and consider disclosure topics and associated industry-based metrics in the industry-based guidance that accompanies the standard. So this guidance is actually based on the SASB standards, and the SASB standards, which are now housed under the ISSB. So, all the climate-related topics and metrics from the SASB industry standards, that is the climate-related risks and opportunities most likely to affect companies in a particular industry, along with the associated metrics to disclose material information. And for those who may not be familiar with the SASB standards, this is a set of 77 sets of industry-specific topics and metrics across 11 sectors. And we have identified the primary industries for most of the world's listed companies. You can look that up. You can use the lookup tool on our website and download the standards for free. One note is that while many companies' business models may fit neatly into one industry, some companies might need to select topics from different industries, say, like an integrated energy company, or say a business that might be both an apparel maker and an e-commerce business. So in this way, many companies will use more than one industry standard. And you mentioned before about the advantage of the fact that we've incorporated the TCFD means that companies already doing the TCFD have a big head start on the ISSB standards. Same goes with the SASB standards. And there are now more than 3,800 SASB reporters around the world. They include, for example, over 90% of the S&P 500, but also more than 75% of the Euro 350 and substantial portions of the large indices elsewhere in the world, including Asia Pacific. So really the world's largest companies are already using SASB standards and TCFD recommendations, and now can work very efficiently to move to the next level of ISSB standards.
Amazing.
Oh, one more thing. Sorry, one more thing I wanted to tell you, sorry, Jacobus, about the SASB standards, and that is that we, in order to make sure that the topics and metrics were suitable to include in the industry-based guidance for S2, we last year completed a project on the international applicability of the SASB standards. So making sure that any reference to, say, a regulatory authority or something was applicable worldwide or generic. And now we're undertaking more work to further update and enhance the SASB standards. And we're doing this by, first of all, starting with a focus on 12 key industries, that we see the most need to focus on. So that would be to start with all eight industries in extractives, so oil and gas and mining and so on, and then electric utilities, and finally, potentially also doing 3 industries under food and beverage. That's processed foods, meat, poultry, and dairy, and agricultural products. So that work is now underway. And the idea is to make sure that the SASB standards are really up to date, that the metrics are still applicable, that we consider any other needs of investors and companies because the SASB standards are so important in supporting IFRS S1 and S2 disclosure.
Mm-hmm. Absolutely. Thank you so much for sharing that insight. And I think handing over also to the core of our session, which is the challenges that come with all these disclosure requirements. Now that we covered some of these basics and the understandings and connections, I think it's fair to say that one of the really challenges are from a reporting perspective, if you're in a company, to navigate a rather fragmented climate reporting landscape. And the ISSB's ambition is to sort of harmonize and create that global baseline that fits into. But for starters, could you maybe place us again, the ISSB, in that landscape of standards, but also bodies? We try to paint a picture here that sort of covers a bit of the wide web of climate disclosures. How does the ISSB fit into all of that?
Well, and thanks, Jacobus. And and this is Matika's illustration, I guess, of the alphabet soup, right? Or at least part of the alphabet soup. And sometimes I think of this kind of slide as the shock and awe slide. It's like this scares our listeners into wanting to listen to us. And but I'll try to explain a little bit about what we've done, what we've achieved here, because as you pointed out, the ISSB really has consolidated the global sustainability disclosure landscape. We have one of the big reasons for creating the ISSB was to reduce complexity and to build on the prevalent investor-focused frameworks and standards. And you can see in this illustration that we have taken the TCFD recommendations, we've taken the SASB standards, Integrated Reporting Framework, Climate Disclosure Standards Board, and really incorporated them into the ISSB, standards. Now, the key point is that the ISSB's global baseline has been developed to provide information to investors, right? The global baseline, what we're talking about, is information to investors. Now, jurisdictions, as well as companies themselves, might then build on that baseline, adding additional building blocks to meet policy goals or to meet the needs of other stakeholders beyond investors, as long as the information is presented in a way that doesn't obscure the global baseline, that doesn't obscure the information to investors. So that's the building blocks approach. Then there's the interoperability, and this is where you see the dotted arrows toward the bottom. The interoperability between policy-focused frameworks like ESRS in the European Union and impact-focused standards like the GRI. And this interoperability is really, really important. Take ESRS. So many companies in Europe and around the world or may choose to apply both the ISSB standards and the European Sustainability Reporting Standards, ESRS. And as the two sets of standards were developed in parallel, we managed to achieve a high degree of alignment in climate-related disclosures. And that alignment is in that area of overlap where they're decision useful for investors, where the disclosures are decision useful for investors. So we have this big area of overlap with common defined terms, with alignment in climate requirements, and very importantly, the financial materiality definition. So in terms of financial materiality, we agree, right? For Europe or for ISSB, the ISSB, under ISSB standards, materiality is judged on the basis of whether omitting, misstating, or obscuring the information could reasonably be expected to influence the decisions of investors. So it's about decision usefulness for investors. Same is true of the financial materiality pillar for the ESRS, but of course they also have the impact materiality side to create double materiality. So that's impact materiality would be decision usefulness for other stakeholders beyond investors. So then, thinking beyond that overlap, there are some additional ISSB requirements for investor-focused disclosures, while, of course, ESRS has those additional requirements for broader impacts. Back in May, we jointly published interoperability guidance, really showing how a company can apply both sets of standards. This includes detailed analysis of that alignment that I talked about, but really, ultimately, what's most important about it, it helps companies reduce duplication by allowing them to collect and govern and control that decision useful data once, even if they're then reporting it to in different for different purposes. Now, very important interoperability point, and this is sometimes overlooked, I think, and I think that this may be eye-opening for companies, especially in Europe, and that is that the ISSB standards refer to ESRS as a source of guidance to identify what information to disclose to meet investor needs other than climate, right? So climate, we have our own climate standard, but beyond climate, ESRS could be a good source of guidance. So as moving from ESRS to ISSB, you could use the very same topics and metrics if they serve investor needs. And then it also goes the other way. Interoperability goes the other way, and that is because ESRS refer to the IFRS industry-based guidance, including the ISSB standards, to help companies complement disclosures for ESRS. So companies for ESRS have to disclose information that is pertinent to them, to their sector, to the circumstances of the entity, and that's where they might use. So I was saying that the TPT materials are really useful. The ISSB standards S2 do not require a transition plan, but where a company has one, it's required to disclose it. Nor does the ISSB standards by any means tell companies how to do a transition plan. But these materials are really helpful in guiding companies on disclosing their transition plans. And then finally, a couple of last two. One is the TNFD, the Task Force on Nature-Related Financial Disclosures. The ISSB will consider how to build on the recommendations of the TNFD to meet investors' information needs around biodiversity. And finally, the Greenhouse Gas Protocol, GHG Protocol. We have new governance arrangements so that the ISSB is actively engaged in updates to the GHG Protocol corporate standard. So you can see the interplay, the interoperability, the work that is going on to streamline corporate reporting, to harmonize, to simplify.
Great. So really, and maybe in a couple of sentences, we could say that it's all coming together in a sense that we look at this global baseline. At the same time, from practitioners' point of view right now, specifically companies in Europe that we're working with are currently preparing a lot for the ESRS and might just wonder how they actually align with IFRS S2 and in general the ISSB standards. And they might have been even reporting on other standards like the CDP or GRI in the past. Is it fair to say that because of that interoperability, it's sort of a shorter way to align with the IFRS S2 standards as well? And should they basically start with a gap analysis to align those requirements?
Well, I wouldn't advise or counsel. It's not the role of the ISSB, but I think that certainly the goal here, as I said, is to reduce the burden on companies, reduce duplication in reporting, and yes, in the case, for example, in the case of the ESRS ISSB interoperability guidance, the intent there is to help a company starting with ESRS, then build on that to meet the ISSB, or maybe a better way to put it is to filter it for the ISSB climate requirements, and then going the other way, starting from the ISSB standards, how to then build on it, and that may include, for example, as you say, a gap analysis, build on it to meet ESRS. So you can start to, you do start to see how you can meet both sets of requirements, starting with a common set of data.
Yeah, absolutely. I think that's a good takeaway to overcome that challenge and sort of have a little bit more clarity in this alphabet soup at the moment. But it's great to hear that it's really all coming together at a global baseline. So I want to move on to the second challenge, and moving a little bit fast here. And that's maybe something that where we share a Mitiga perspective, again, because it's maybe beyond the role of a standard setter. But we see companies rarely having the skill set and the in-house capabilities to perform physical climate risk assessment specifically. And there's a huge market out there that with many providers. So it's really sometimes a challenging question. How can I really select the right climate risk provider for my business, for my company? So we put together a bit of a list of criteria to assess the quality of climate risk services, knowing that this might be even beyond complying with some of the standards and regulations, but really to help that process. And I want to touch a little bit on these criteria before moving on. We see three basic pillars, and the first one is really on the scope and the coverage of the hazards that providers do. From our perspective, there's currently no climate risk provider that covers all hazards that are basically available. So it might be a good start to define and think of the material risks that are inherent to the company. It might be also good to start talking about the types of assets the company's having, and also the geographical reach is fundamental, because ultimately it has to cover your value chain, your business activities. We see, for example, that some climate models do extremely well on land, but are less reliable on water. So if you, for example, operate offshore assets, this is something you want to factor into that decision. And that really is one of the pillars. And the second pillar I want to touch on is the second one here with the reliability of data and risk models. And it speaks again to standards and maybe the room there still is in terms of methodologies. But really here, the key thing is if it's backed by science, it also has the need to be validated externally with independent data sets. It should be very transparent over the methodology and interpretation. Ultimately, that's not only because of a standard requirement, but it's also that companies ultimately need to work with the risk data that they receive from such providers. And it's fair to say that climate output models are not equal, like they do not equal decision useful information at the same time. Yeah, there's a really data processing and mathematical analysis needed to bring it to that level. And I think something to factor into that decision when selecting a climate risk provider. You see a couple of more criteria here listed. I don't want to go into all the details, but it doesn't have probably all criteria. It's not an exhaustive list, but I think it's a good start to have an informed discussion with risk providers and find one that suits the business needs. Moving on to the third challenge we see as very critical, we are experiencing a paradigm shift somehow. And that is that when disclosing on climate risk specifically, it's really moving from a narrative to data-centric and financial risk reporting. Neil, basically from a company perspective, how can companies ensure that they are communicating climate risks accurately and in a way that meets really the investor expectations.
Well, I think it's fair to call this a paradigm shift. As you say, there's this shift in and what the shift is doing is it's raising sustainability reporting to the level of financial reporting, right? And what the ISSB standards have really done to the field of sustainability disclosure is to bring accounting discipline to sustainability disclosure, an area that hasn't always had accounting discipline. And that means factors like considering the processes and the controls around the data as it's gathered, as it's verified, and as it's signed off and reported. Now, the one point to make right up front is that the ISSB doesn't require assurance. Our role as a standard setter is to make sure that the disclosure resulting from our standards is assurable. And definitely what we are seeing, what we expect to see, is that as jurisdictions incorporate the ISSB standards into their frameworks, they will likely require assurance in the same way that the EU is requiring assurance for the SRS disclosure. The SEC is proposed requiring assurance for its climate disclosure rule, and so on. So I think that in thinking about this accounting discipline and thinking about really creating investor grade disclosure, to your question about meeting investor expectations, I think two aspects to focus on. One would be connectivity with the financial statements, and then the second aspect is what I term disclosure quality. So in terms of connectivity, IFRS S1 requires a company to provide information that really enables investors to understand connections. So connections between sustainability-related risks and opportunities, but also connections between the sustainability related financial disclosures and the financial statements, the financial results. So these might be connections between core content, disclosure requirements around governance, strategy, risk management, and so on. But it also includes connections right across sustainability-related financial disclosures and other parts of the company's financial reporting. So to help with understanding these connections, S1 requires that, for example, that the S1 and S2 disclosures be prepared for the same reporting entity and for the same reporting period as the related financial statements, and also requires that these disclosures be provided at the same time and as part of the same package of reports. Furthermore, S1 requires a company to use data and assumptions that are consistent to the extent possible with the corresponding data and assumptions in preparing related financial statements. And remember, again, when I say S1 requires, then those requirements also apply to S2 disclosures, right, in terms of these foundational concepts. S1 also requires a company to identify how sustainability-related risks and opportunities have affected its financial position, its financial performance, its cash flows for the reporting period. So back to your point about really starting to identify the financial effects. And this is all designed to ensure that the package of information containing the financial statements and the sustainability information resulting from the ISSB standards really work well together as to create a complete picture to inform investors. And then briefly, just on the aspect of disclosure quality, the completeness, the accuracy, the verifiability of data, that in many ways can be supported by the controls and the processes that we see companies put in place. And again, this is not within the standards in terms of requirement, but what we do see is companies building out these processes, building out these controls, making sure that they have the governance right around disclosure to be able to make sure that this data is investor grade and can really help drive investor decisions.
Yeah, very clear and good summary. I think it's also leveraging the processes that are in place, right? And at the same time, it's really making that connection and cross-functional effort. After all, it's of course not only on ESG teams but also on financial teams to to come up with that really high quality of data that investors expect. Great, and I think with that we sort of look a little bit into the future of climate disclosure. We brought a couple of numbers that ultimately underline the significance and the relevance of what we've just been discussing. For example, we see that climate risks are materializing financially. We see that business leaders, and 48%, I think, is a lot, believe that operational disruptions will be caused by climate change. We see, again, a number of climate policies around the world that is astonishing, and also under the CDP, the companies reporting on climate change see that financial impact and strategic impact from climate-related risks. So I think just proving your point from earlier that it becomes more and more critical. How do you see the IFRS S2 with the top of that evolving to address the increasing demand for more detailed data-driven disclosures, specifically in climate?
Yeah, so I think one of the most important things to consider is the convergence of what we're going to see is the convergence of sustainability data and sustainability action, or even more importantly, incorporating this data into strategic decision making and as well as enterprise risk management. So this is not just about compliance and disclosure; it's really about the business itself. So going back to my point about connected reporting, this serves not only the investor, but it also serves the company in really aligning sustainability disclosures with how the company creates value over the short, medium, and long term. And in terms of the consistency of the dialogue, really allowing for a complete picture of financial and sustainability performance to support the relationship with the providers of capital, with investors. And I talked about investor grade data, but I also think about it as board ready data. It really and one of the things that the ISSB standards are doing and are achieving is building structure and processes around this traditionally unstructured information on sustainability related risks and opportunities that could really affect a company's prospects. And just a note about how I see S2 evolving. A couple of points. First of all, I think it should reassure companies that S2 won't keep changing, right? Like S2 has been established. It's going to, and in order to evolve it or change it, it would take due process, public consultation, public comments, and so on. It would take a tremendous process. But that said, what I think you can see is that we're kind of coloring around the edges to support S2 as well as S1. One great example would be our digital taxonomy, right? So we created a digital tagging for ISSB disclosures that really will help investors in consuming the information, but will also help the interoperability between standards and frameworks. So if we can have a common digital language underpinning the ESRS and the ISSB standards and the GRI standards, then it will really reduce the burden for companies, will reduce the noise for investors. I also I referred to the transition plan disclosure materials, which for now we are going to be adapting to the IFRS standards. So making sure that they're global in applicability, making sure that they serve the needs of investors. So again, supporting S2 around the sides. And we have been putting out some really helpful educational materials over the last year to, again, support S2. So for example, we put out a piece on the nature and social aspects of climate-related risks and opportunities. And we also did a pair of webcasts on current and anticipated financial effects. And looking ahead, keep your eyes open. We're going to continue to support the implementation of S1 and S2 with educational materials that will really help companies, make the most of these standards, both for that trend, as I talked about, of driving strategy and risk management, and also to really help their investors.
Perfect. I think, yeah, thank you so much for your insights, Neil. The future of climate disclosure is certainly an evolving one, and it's clear that companies need to be well prepared to meet these demands. Yeah, I think with that, we've covered a lot of ground today. Before we open for any questions, any final comments from your side, Neil?
Well, I think there may be three key takeaways I want to emphasize. And as I just described, one of the things that the ISSB standards have brought to this landscape is the ability to build structure and processes around intricate data that management then needs, boards need, even operational managers around the company need to ultimately contribute to long-term performance, to improve the company's prospects. And then the second thing is that the ISSB standards do is that they really are helping companies navigate future regulatory changes. So what we see is that companies, no matter where in the world they might be, no matter what their regulatory requirements are going to be, this is a way to help navigate those future regulatory changes. The ISSB standards have been described as a no-regrets approach to this future of mandatory reporting. And tied to that, the third aspect is that the standards really are a passport to a growing number of jurisdictions worldwide. As you talked about at the top of the webinar, we're now at close to 30, over around 28 jurisdictions that have begun to adopt the ISSB standards or incorporate them or otherwise use them. And this really, ultimately, this passport for companies gives access to capital, gives access to customers and suppliers, all while meeting regulatory requirements. So I think you can start to see the business case, but also the investor case for the ISSB standards.
Absolutely. Thank you so much for sharing such valuable insights from the IFRS Foundation, Neil. And thank you everyone for attending today's session. We hope you found this webinar informative and that it helps you navigate the evolving climate disclosure landscape, but the evolving disclosure landscape in general. And yeah, please don't hesitate to reach out if you have any questions. We're happy to answer that. Have a great day.